Today, we're tackling a controversial topic, the idea of holding a 100% stock portfolio in retirement. Now, I know this might sound a bit radical to some of you, especially if you've been following conventional wisdom about reducing risk as you approach retirement. But let's explore this idea in depth and see what the latest research has to say about it. If you find topics like this helpful, take a moment to subscribe for future content. Your support is very much appreciated. Before we delve into the main topic, let's briefly touch on the accumulation phase. If you're still in the wealth building stage of your life, with more than 5 years until retirement, a 100% stock portfolio works really well. Vanguard's data shows that over a 96-year period from 1926 to 2022, a portfolio of 100% US stocks averaged an impressive 10.2% annual return. However, it's crucial to note that this comes with significant volatility. Within a single calendar year, your portfolio could potentially gain as much as 54% or drop by up to 43%. That's a massive swing of 97%, though it's unlikely to occur within the same year. This level of volatility isn't for everyone. You need a strong stomach and the fortitude to stay the course during deep bear markets. But if you're in your 20s or even 40s, sticking with a 100% stock portfolio through thick and thin can potentially lead to substantial gains. The secret sauce here is time. Time allows you to ride out market fluctuations and benefit from long-term growth. Now, let's shift our focus to the decumulation or retirement phase, which is the main subject of our discussion today. We're going to look at a paper titled Beyond the Status Quo, or BTSQ, published in October 2023. This paper has caused quite a stir because it challenges two central tenets of lifecycle investing: that savers should diversify across stocks and bonds, and that they should reduce their equity exposure as they age. Instead, it advocates for a constant allocation of 50% domestic and 50% international stocks, across both accumulation and decumulation phases. This directly contradicts the typical lifecycle investing advice that suggests investors should reduce equity exposure as they age. The paper covers several asset allocation scenarios, but we'll focus primarily on what they call the balanced and stocks scenarios. I should mention that I'm not a fan of target date funds for long-term accumulation, nor am I particularly fond of age-based heuristics. So, we'll be setting those aside for this discussion. Let's start with wealth at retirement. Unsurprisingly, the 100% stock portfolios have the highest portfolio values at the end of the accumulation phase. This aligns with the common advice to prioritize equities during the wealth accumulation phase. Now, turning to the probability of financial ruin in retirement, which is statistically defined as the number of samples in their 1 million simulations, where the portfolio is depleted at the end of 30 years. For a US retiree, the balanced domestic-only scenario has a slightly lower probability of failure than the all-equity scenarios, but it's lower by only 0.5%. For non-US retirees, the difference between balanced and stock scenarios is at most 1.7% and 2.7% respectively. Interestingly, the 1.7% difference is in favor of the balanced domestic portfolio, not the all-equity portfolio. The BTSQ paper makes three main arguments. First, it claims that a 100% global stock portfolio is the most effective strategy for retirement, superior to traditional diversification strategies. This isn't just about higher returns, but also about the long-term sustainability of retirement funds. Second, it advocates for a fixed 100% stock portfolio throughout an investor's lifetime. Third, it critiques conventional asset allocation strategies, suggesting that by reducing equity exposure over time, investors may be limiting their potential for growth and risking a less secure retirement. However, it's important to note that there are some concerns with the BTSQ paper's outcomes. One major issue is the data used for the bootstrap. The paper includes data from countries with vastly different economic and political histories, including those with histories of numerous wars and communism. Critics argue that this data might not be relevant for investors in more stable economies like the US or UK. Additionally, the paper uses non-consecutive historical data from multiple developed countries, whereas other research on safe withdrawal rates typically uses consecutive data. Another concern is that the paper assumes a fixed allocation model throughout a person's lifetime. It uses the same portfolio allocation in both pre-retirement and retirement. However, I question the benefit of committing to a single, static portfolio allocation throughout your life. Circumstances change, and it isn't unreasonable to change your allocation. A specific note for UK investors, which may also be applicable to investors elsewhere: a 50% stock allocation to the UK is, in my opinion, far too high. This might work for US investors, but I'm not convinced for other countries. Now, let's look at some other research on this topic. There's actually a strong body of work that disagrees with the idea that a 100% stock portfolio has the highest probability of success in retirement. We'll review a few key studies in chronological order. Cliff Anness's 1996 paper, Why Not 100% Equities, warns of the severe losses and long recoveries tied to all stock portfolios. He advocates adding bonds to reduce volatility and improve risk-adjusted returns. In 2010, Wade Pfau published a study that looked at optimal asset allocations across different countries. Interestingly, only South Africa, France, and Japan had the highest safe withdrawal rates when using a 100% stock portfolio. For the US, while 100% stocks was optimal for a significant period, there were notable exceptions, particularly around the Great Depression and the decade following 1966. Michael Kitzes, in a 2013 study, challenged the conventional wisdom of decreasing equity exposure during retirement. He suggested that a rising equity glide path could be more effective. His research found that a portfolio starting at 30% equities and rising to 70% had a 95% success rate, compared to 88% for a static 100% stock portfolio. The following year, Kitzes and Pfau collaborated on a paper examining rising equity glide paths. Using different capital market assumptions, they found that for a 4% withdrawal rate, optimal starting equity exposures were generally around 20% to 40%, increasing to 50% to 90% by the end of a 30-year retirement horizon. In all scenarios they examined, 100% stocks did not provide the highest probability of success. When assuming lower future returns, the 100% stock allocation achieved a 64% success rate. However, you could actually achieve a slightly higher success rate of 65% with several other allocations, including the static 70-30 and 80-20 portfolios. Javier Estrada's 2016 paper on global asset allocation in retirement explored the merits of a 90-10 stock bond allocation as suggested by Warren Buffett. Looking at data from 21 countries, Estrada found that 100% stock portfolios had the lowest failure rate on average, across all 21 countries, but only by a small margin, barely 0.3% lower than a 90-10 portfolio, and only 2.9% lower than a 60-40 portfolio. Interestingly, when looking at US data specifically, the 100% stock portfolio actually had one of the highest failure rates at 3.5%. While the 60-40 portfolio had a 0% failure rate. Most recently, in 2024, Carsten Jeske of Early Retirement Now directly addressed the BTSQ paper. While he found that a 100% stock portfolio did end up with the highest final value over a 30-year period, from 1972 to 2002, he also noted that it had the highest volatility. However, when he moved the retirement date to the beginning of the dot-com crash, the 100% stock portfolios were very likely to deplete before the 30-year mark. This highlights the significant impact of sequence of returns risk. As you can see, there's a substantial body of research, spanning from 1996 to 2024, that challenges the assertion that a 100% stock portfolio offers the highest probability of success in retirement. Now, even if we were to accept the BTSQ paper's conclusion that a 100% stock portfolio is optimal, I still have significant concerns with a 100% equity approach in retirement. First, the improvements in probability of ruin are marginal at best. We're talking about a 2.7% and 1% reduction in failure rate for a massive increase in volatility and portfolio risk. Is that worth it? Second, a 100% stock portfolio inherently comes with much higher volatility and deeper drawdowns. This can magnify sequence of returns risk, as demonstrated by Jeske's analysis of a retiree starting in 2000. Do you have the fortitude to watch your portfolio plummet by 50% or more, just when you need to start withdrawing from it? As William Bernstein famously said, when you've won the game, stop playing. So, do you really need to maximize your wealth at the expense of peace of mind in retirement? Third, and perhaps most importantly, there's the human element of behavioral risk to consider. This is the critical issue I have with an all-equity portfolio in retirement. Could you really stomach seeing your portfolio nosedive by 60% without losing sleep, panicking and selling, locking in losses early in your retirement.
That is a most illogical attitude.
This is especially dangerous in decumulation, when your risk capacity is lower than during your accumulation years. The authors of the BTSQ paper had anticipated this concern as a potential criticism of their all-equity strategy. However, their proposed solution of financial education as a remedy for this issue seems overly simplistic and, frankly, a little, what's the word? Naive. Morningstar's annual risk tolerance questionnaire finds that age and income level are key factors in risk tolerance. As a retiree, you might find it much harder to stay the course during a severe market downturn, when you're no longer earning an income to offset the losses. So, under what conditions might you consider a 100% equity portfolio in retirement? It really comes down to two factors: risk tolerance and risk capacity. For risk tolerance, you need to be supremely confident that you won't flinch in the future. If your portfolio drops by 60%, as the S&P 500 did in the global financial crisis, you need to be certain that your future self will remain calm and act rationally. I'm not sure I'd be able to do that. As for risk capacity, you ideally want three things. First, a diverse set of non-portfolio income sources beyond your retirement pot, such as rental income, part-time work and state pension. Second, you should also have a high level of discretionary expenses, upwards of 25% to 50% of your total spending, giving you flexibility to cut back when needed. Finally, you should be starting with a low initial withdrawal rate. This can be achieved by either having lower expenses or a larger retirement portfolio, or a combination of both. A low withdrawal rate provides a substantial safety margin, especially if sequence of returns risk strikes early in your retirement. Now, would I personally use an all-equity portfolio in retirement? No, it's not for me. The potential benefits don't outweigh the risks and stress in my view. If you are seriously considering this approach, I have one question for you: why? As William Bernstein wisely said, when you've won the game, stop playing. Thank you for joining me today. If you found this video helpful and want to dive deeper into preparing for retirement, I recommend checking out this video that walks you through a pre-retirement checklist and some critical actions. If you found this thought-provoking, remember to like, share and subscribe to support our channel. Thanks again for watching, and I'll see you in the next one.